Hey, Dan Passarelli here. How are you feeling today? Yes, I am in a new location and new location, new topic. Today we're going to talk about something I get asked about a lot these days, and that's how to election proof your stocks with puts. Now, I want to make sure you can hear me. Please head on over to the chat box and give me a big old yes if you can hear me. Give me a big old yes if you can hear me. Yes, can you hear me? Ah, there we go. Oh, Q&A box. Sorry about that, folks. To the Q&A box is where we need to go. I was just reminded of that. Okay, thanks, Dan. And Deja and Thomas and Anonymous. Keep it a secret who that is. Yossi, another Anonymous. Are you guys related? All right. Before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Now, for those of you who it's your first time joining me, I do these every Tuesday. But your first time joining me, allow myself to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. And I am a trader. Spent many years down on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group, and a denizen of the Chicago trading floors. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. And I am a trading industry collaborator. I've worked with every major options exchange literally in the world. I collaborate with the top options friendly brokerage firms like Firstrade and others. And I'm a family man, married to my wife, Kathleen, my two adult children, Sam and Isabel, and two cute little 6-pound dogs. And I'm a runner, foodie, traveler, and musician. Now, today, I want to give you something. We're going to have a training on buying protective puts and married puts and talk about some of the problems with those and some of the solutions to overcome those problems. But in the meantime, you're going to want some more training following today's presentation. So if you go to markettaker.com, as you can see up here, market as in stock market, taker as in take what is rightfully yours, two T's in a row, markettaker.com. And just click on join free up here in the top right-hand corner. We've got some free classes. And you can even join our chat room for free right now. All right. So when you first start learning about options, one of the first things you learn is, well, I could buy a call instead of buying the stock. I'm in a new location because I'm at my mom's house. And I flew out last night and I was sitting in O'Hare Airport and I was chatting with the guy next to me and, we're just shooting the breeze, but inevitably it comes to what do you do for a living? And it's like, well, I train people on how to trade options. And his eyes lit up and he's got his grin and he's like, oh yeah, tell me if I got this right. And he describes the call and I was like, well, let me just say that a little bit differently. But that's, I think, one of the first things that we learn when we first hear about options. This is a call. We could buy a call if we think the stock's going up. But soon after that, the second thing we learn is we can protect stocks that we own, our long-term investment holdings, by buying puts, because puts are thought to be insurance policies. And there's a lot of truth to that, but there's some fallacy to that as well. Let's take a look. We're going to talk about what puts are really quick and how put options are essentially insurance. And we're going to talk about the two different types of insurance we could buy, married puts and protected puts. And then we'll wrap it up. So let's quickly review a put. Hey, by the way, hit the questions box for me. Is anybody just brand new to option trading? Give me a yes or a no. Are you brand new to option trading, or do you have experience? Hit that questions box, Q&A box. Thomas is not brand new. Anybody else? Vince is not brand new. Anybody else? Keith is not brand new. We're all friends here. No need to be, embarrassed or anything. All right. Well, then I'm going to go pretty quick through the review part. Norton is brand new. Okay, good. All right. Well, I'm going to go quick but decisive so that I'll catch up the new folks. So first of all, a put is a contract that gives the buyer the right to sell an underlying security. And generally, we're talking about a stock or an ETF. And the contract goes kind of like this. You can buy or sell options. And when I say sell, I don't mean buy them today and sell them tomorrow. I mean sell them even though you don't have them, so selling them short. Today, of course, we'll be talking about buying them. Each one contract represents the rights on 100 shares. So if I own 100 shares, I'd protect that by buying one put of whatever the stock is. XYZ is the hypothetical symbol we use to make things up. August is the expiration. If there's no other date next to them, typically that means they're the monthly contract that expire the third Friday of the month. So a lot of stocks have weekly options listed on them that expire every Friday. 70 is the strike price. That is, if I did exercise my right in this contract, I would sell the stock at $70 a share. And a put is the contract that gives me the right to sell. A call is the contract that gives me the right to buy. And $2 is the price that I pay. Now, this is stated per share. So $2 per share, and each one contract represents 100 shares, means that if it says $2, that actually means $200 of actual money. Okay. Now, this one, it's important to understand that there are two components. Where my mom lives, there's something in the air that I'm extremely allergic to, and I don't know what it is. This has never happened before, but bear with me. It's important to understand that there are two components to option prices. There's what we call intrinsic value and what we call time value. So intrinsic value is what we call the in the money value, and time value is everything else. An option may or may not have intrinsic value, but it'll always have time value. So with puts, we just simply take the stock price minus the strike price, or the other way around. It doesn't matter. We don't really care about the negative sign or a positive sign. We're just looking for the value. That's intrinsic value. So if we have the 40 strike put and the stock is at 38, these puts are in the money by $2, because if we exercised our right to sell this stock at 40, we could just buy it back in the market at 38 and lock in $2 of profit. It's intrinsically worth $2. But it's, in this example, it's actually trading at $3.20. So that is that leftover value that I was talking about. So the intrinsic value is $2. 320 minus 2 is $1.20. So there's $1.20 of time value. Now that does become relevant when we're talking about protected puts, and that's why I felt it was important to go through that part. Now, if I buy an option, I can do three things with it. Or I guess I should say one of three things will happen. One, we can exercise that right. And if the option is in the money, well, we would do that. If we want to sell the stock. But if we don't want to sell the stock, we could just sell the put. And we could sell it for a profit. We could sell it for a loss to keep the residual value, to keep our losses smaller. Or if it's out of the money, we can just hold the contract all the way until expiration. And when the bell rings at the end of the day on expiration day, it expires and the rights cease to exist. All right. Easy peasy, right? Well, I said that put options are kind of like insurance. Well, let's take a look at that. Anybody have insurance on your car or your house or your life for that matter? It's a better analogy with your car or house. So with the car, you're insuring this asset, a vehicle, right? That has a certain monetary value. And if you have to exercise the right in that contract by filing a claim, the first amount of money is on you. That's called the deductible, and it helps keep the premiums a little bit lower. And if you ever bought an insurance policy, they tend to last for a year or maybe 6 months. I think it's normally a year. And when that year expires, you can renew it or whatever. Interest rates actually factor in, believe it or not, because all assets have a risk-free rate, and inflation is tied into real interest rates. And so, if interest rates are higher, there's the implication that car prices and car repairs might be higher in the future. And so that would affect the value of this whole contract. And then, there is the risk. And all these factors play into the premium that you pay. Now, let's take a look at how that works with options. Well, there's an asset there too, and it's the stock. So we're insuring the value of that stock. Now, different strike prices allow us to sell the stock at different prices. If it's $100 stock, I can buy the 100 strike price, and I could sell the stock at 100 if it goes down from there. Or the lower the strike price, the cheaper the put. I could buy a 95 strike put and I'd pay less for it. But if the stock falls from 100 to 95, that first bit of loss is on me. That's kind of like the deductible. And then the time period most options aren't a year long, but their expiration date is published, right there in the option chain. And you know exactly when the option expires. Interest rates and dividends come into play. And finally, the risk, and I kind of glossed over the risk when it comes to insurance. If this is, like a 40-year-old soccer mom with a minivan in a nice suburb versus a 18-year-old kid with a red beater muscle car, the soccer mom's going to pay less for her insurance than the 18-year-old kid with the red muscle car. Why? Perception of risk. You feel that it might be more likely. I don't know why. Maybe the soccer mom's a bad driver, but I think the actuaries would say that she's less likely to crash her car than the kid. Well, it kind of works like that with stocks too. Sometimes our perception of risk in the market is very low. And we think, well, there's not too much chance of this stock that I own going down. So, I'm not desperate for puts to protect me. And if nobody's really desperate for puts to protect them, the price is lower. Why? Because of the laws of supply and demand. There's less demand. But if there's the perception in the market as a whole that, hey, you know what, this stock is facing some troubles here, or geez, there's a lot of risk in the market overall, more people might want to protect themselves with puts. And that demand that's created drives the price of puts up. And we call that component volatility, specifically implied volatility, which is, a little bit of a stretch. But that's the name that we use, and just know that the implied volatility is the supply and demand factor. All right, now a put gives the owner the right to sell stock at a set price, the strike price. And because we own the stock and now we own the put, there's two components to this investment, stock and put. And whenever there's two components to a trade, we call that a spread. Now, those of you who are experienced, you might say, well, Dan, it's just protecting the stock. It's not really a spread. A spread is two options. And that's commonly how we think about it. But I would say if we want to get technical with the definition, stock matters as well. So this is a two-component spread. So that put gives me the right to sell already owned stock at the strike price. Now, let's talk about the married put now. A married put is the simultaneous purchase of stock and puts on a share-to-share basis. Now, I say share-to-share basis because each one put represents the rights on 100 shares. And so if I buy one put, well, I guess I should say if I'm going to buy 100 shares, I'm going to buy one put. Okay? If I exercise that one put, it gives me the right to sell these 100 shares. So a married put, by definition, is trading both of these at the same time, buying the stock, buying the put as a single trade. And that's why it was important for me to point out this sort of technical definition that it is a spread. So here's the situation. Let's say there's a stock that we kind of want to buy, but maybe we're nervous about something. Maybe, for example, the election. And so we want to be cautious. We want to own the stock, especially since I think many times historically, stocks tend to go up after elections, regardless of who wins, because markets dislike uncertainty and they like certainty. So, we might not want to wait until after the election, but who knows? The market's perception before, during, and maybe even after the election could cause it to sell off. So we want to be cautious. So what we would do is we would buy an at the money married put. We would buy 100 shares of the stock at $50 where it's trading. And as part of one trade at the same time, buy one of the May 50 puts at $1.50. And just insert whatever month you want. It doesn't matter what month. So the implication is we now own the stock because we bought it. But we also own the right to sell it at 50 until expiration if things go south. So right now the stock is at 50 in this example. The premium we paid for the put is $1.50. Now, what we paid for it is not necessarily, well, what we paid for it doesn't ever change. Just like when you buy insurance and you pay your insurance premium of like thousands of dollars, because that's what it is these days. You write that check and they cash the check, and that's the money you paid for it. But you may exercise it. You may not exercise it. You might file a claim. You might not file a claim. And to be fair, car insurance is a cost that we don't mind losing money on, right? Nobody gets to the end of the year and says, oh, crap, man, I didn't crash my car. Darn it. What a waste of money that insurance was, right? Like that's not what happens. And that's sort of the mind frame that you should have for options as well, specifically married or protected puts as well. If the stock goes up, like in this case, we think it will, because remember, we're bullish but cautious, and it's trading, let's say 51 at expiration, well, the put ends up being worthless. And we lose $1.50 on the put. Well, actually, if I want to be here, actually, I could be a little bit more specific here. If the stock is at 51, we'd make $1 on the stock, but the premium costs us $1.50. So we lose $1.50 on the puts, but we actually make $1 on the stock. So we're only down 50 cents. If the stock's at 52, we'd actually be up 50 cents. Stock's at 53, we'd be up $1.50, because I will have made $3 on the stock going from 50 to 53, but my fixed cost is the premium of $1.50. If we're right at 50 cents, then we lose the premium we paid for this insurance, which again is okay. We love losing money on insurance, especially life insurance or car insurance or fire insurance. We love losing money on that. Same thing with a protected put. Now, if the stock goes down, let's say it goes down to 49, $1, well, the put value is going to be worth $1. But we lost $1 on the stock. So I paid $1.50. lost $1 on the stock, I make 50, or I'm down 50 cents. My break even would be 48.50, because at 48.50, I'm down $1.50 on the stock, which covers what I paid for my insurance. So that's my break even point. Stock goes down to like 46, and I'd be up, or I would have lost $4 on the stock, and I paid $1.50, so I'm really down $6.50, but my put is worth $4, so I'm up $2.50. Now, looking at a little matrix like this might be helpful to you, or it might not. It can be, maybe it's more helpful to look at this. The dotted line is simply owning the stock. Okay. And that's pretty easy. If I bought it at 50 and it goes up $1, I make $1. It goes down $1, I lose $1. Easy peasy. But the green line is owning the stock and owning the put. So let's look at the below the strike scenario first. If the stock is below 50, okay, see you, Thomas. If the stock is below 50, that's okay. I own insurance. I'm going to sell it at 50, no matter how low the stock goes. Stock can go to $1 and I can still sell it at 50, which would be a very valuable right to have, wouldn't it? It cost me money to buy that right, $1.50. So the most I can lose is $1.50. So if I get down below 48.50, which should be like right about here, that's kind of my indifference point. If we're below 48.50, I'm really glad I bought the put. If not, well, I might still be glad I bought insurance because it probably helped me sleep. But if we're above $50 a share, then we won't exercise our right to own the stock or to sell the stock. We just simply own the stock, and the put that we paid for, that insurance policy, expires. And so we always underperform owning the stock by the amount of the value of the put, the amount of the insurance. And so the stock basically has to rise up by $51 or by $1.50. It has to rise up above $51.50 in order to break even. Now, again, the purpose of insurance is really to help you sleep and to know that you're protected if a big move happens to the downside. So the reason why I show the break even on this side and what I'll call the indifference point on this side is because that's the only drawback. Between 48.50 and 51.50, that's where, like, that's the suboptimal scenario. If we're up above 51.50, then we made money, and we make less than we would have not buying the put, but nobody has a crystal ball. We don't know what's going to happen, so that's okay. And if we're down below 48.50, then we know that we're protected, and we're really glad that we have that put. So that's a married put, where you buy them both at the same time. A protective put is when we already own the shares. Let's say we currently own 100 shares of XYZ, which is trading at $50 a share, right? Now, we like owning that stock. We don't want to sell that stock, but we got the election. We're a little nervous. Most people are probably more nervous than they should be, but it's fair enough to be nervous about it. You never know what could happen. So we don't want to sell the stock, but we're a little worried about this election scenario. So what we'll do is we'll buy an at the money protected put. We'll buy the 50 strike put at $1.50. So we now bought the right to sell those 100 shares at 50. So it's exactly the same darn thing. Exact same darn thing. And I feel like the matrix is a little harder to go over. Let's look at this. It's the exact same scenario. The only real difference is the timing of when you buy it, is when you buy the stock versus when you buy the put. The married put, you do it at the same time. Protective put, you do it, you already own the stock. Now, this is why I brought up intrinsic value. Let's see here. Before expiration, the option may have both. At expiration, the option only has intrinsic value. That's why we're factoring in that $1.50. There's no time value we only have when there is still time to expiration. But there's kind of a problem with this whole thing, and that is time decay. As time passes, options lose their value. But because before expiration, we have intrinsic value and time value, we might be able to sell the option for more than the intrinsic value. We might be able to sell it for extra, including a time value component. So it ends up being a lot better than everything else we looked at and talked about. And that brings up a couple of really important things. When we talk about the options for your options, we could exercise our right to sell the underlying. I don't know why it says buy, to sell the underlying. Let me fix that. A second. Go. All fixed. We could exercise our right. Now, if we exercise our right to sell the stock, at the strike price, whatever value, intrinsic or time value we have, gets flushed down the toilet. Now, that's okay because the intrinsic value is the difference between where the strike price is and where the stock price is, and we're going to capture that value. Because if it's a 50 strike put and stock's at 47, the put will have to be worth at least $3 because it's intrinsically worth $3 and might have some time value, might be worth more than $3. But if we exercise it, whatever it's worth is gone. But we can sell the stock at 50 and buy it back at 47. So we still end up capturing that $3, which is the intrinsic value. And let's skip down to the bottom here, expire. If the option is out of the money, it'll have no intrinsic value. And once expiration comes around, it expires and all the time value is gone too. But that brings us to this middle one, sell. We can sell to close that position after expiration, or no, at or before expiration. So there's a big benefit to that. If I buy those puts at $1.50, let's say the stock is trading at 47, and this is after the election and all the dust settles, right? And maybe the market's down from then. Maybe the reason does have to do with the outcome of the election. Maybe it doesn't. But if the stock is down, say it's at 47, we paid $1.50 for that put. Now it's got to be worth at least $3, right? Because we own the right to sell at 50 and it's trading 47 intrinsically, which just means like, purely intrinsically it is worth $3, but there's probably time value. We might be able to sell it for like 350. And so why would we exercise it and throw away that 50 cents of time value? We would instead sell it at 350 and we still capture that $3, but we also capture the time value. So truth be told, most people who have married puts or protective puts, they never exercise their right. They just simply sell the option because the math works out the same either way. You capture that intrinsic value either by selling at the strike and buying the stock, or the option's worth the intrinsic value anyway. So it's just easier just to sell the put and take a profit and think of that as P&Ling it against how much I lost on the stock. And, that comes into play too. We're not really talking about taxes because I'm no tax expert by any stretch of the imagination. But like, if I have a really low cost basis on my stock, maybe I bought it 20 years ago and it split 7 times. I own the stock at like a cost basis of $1 and now it's trading 50. If I sell the stock, I got to pay taxes on that probably, depending. But if I just sell the put, I only have to pay taxes on the value of the put. And again, talk to your accountant about all this stuff. I'm not a tax expert, but just to give you an idea, because that does come into play, that is definitely something you should talk to your accountant about. But, there's something else here that's important. That $1.50 premium in this hypothetical example, that's 3% of the price of the stock. $1.50 divided by 50 is 3%. So if I'm able to protect my stock for like a year, giving up 3%, I'd be good doing that. But here's the reality of it. You can't buy a year's worth of protection with puts for 3%. 3% is more like a month or two worth of protection. Probably closer to 2 months of protection. But if that's 2 months of protection and there's 12 months in a year, that comes out to 18% that you would be giving up on your stock. And that's a pretty realistic figure there. So there's a couple of things. We want to be very selective of when we decide to buy protective or married puts. We want to be very selective. If we always own puts all the time, we're definitely going to underperform the market. Just because it is very expensive insurance. But if we only buy them when the risk is the greatest, then we're not holding it that whole time. We're not losing time value as every day passes because we don't have it every day. So we only want to buy them when needed. And we're going to sell them to recoup residual value once protection is no longer needed. If the stock goes down, we'll sell that put and take the money we made on that put to offset what we lost on the stock, and we're in good shape. But if the stock goes up, then the election has passed, the good one or the bad one got into office, whoever we think is the good one or the bad one in our minds, and all the dust settles and everything's fine. The world didn't end, right? Market goes up. We don't need this insurance anymore. Well, what we do is we sell that put to get rid of it. Maybe we originally bought it at $1.50. Now it's trading at 47 cents. We'll sell it at 47 cents. Now we didn't lose $1.50. We only lost $1.03. But this thing about only buying it when needed, and this thing about selective use, there's kind of a problem with that too. Because if you are looking at a stock that you own and you think, oh boy, next week, maybe it is because of the election, there's way too much risk. I need protection. I'm thinking I might buy a put. Okay. Who here thinks that they are the smartest investor in the world? Nobody? Nobody? Oh, well, that's good. You have some humility and you're being real to yourself. If you think that, there's probably a whole bunch of other people who think that. And you and they create demand for that put. And that makes the value of the put go up. So what I'm saying is puts get more expensive when the market as a whole is buying them, presumably because they perceive there to be more risk going forward. And so that can be kind of a challenge too. This 3% could become 4%. Instead of paying $1.50 for 2 months of protection, I might be paying $2 or $2.50 for 2 months of protection. Once the event, election in this case, that we fear will cause market volatility is over, then if the stock is still at 50, those puts might be trading at 2% or something. I mean, time would have passed as well, but I think you get what I'm saying. So how do you overcome that? Well, one is you've got to be a little preemptive. You can't wait until like everybody realizes, crap, there's a bunch of risk. You have to be a little bit more aggressive. I refer to traders and investors often in presentation as action takers, because that's what we do. If we hem and haw and aren't really sure and we want to wait, and you wait until the last minute, you're going to buy massively overpriced insurance. And even if it comes into play because the stock does go down, that indifference point becomes very, very low. If today somebody can buy those puts at $1.50, but you wait until Friday, those puts might be $2 or $2.50. It's hard to say because there's a couple of factors that are competing against each other. One is time decay. As time passes, options get worth less. So intuitively, that component of the option price makes them worth less as time passes. So the difference between today and Friday, the option would get worth less. But as fear of uncertainty increases throughout the week, the demand for those puts may also increase. And you might end up paying more for them then than you can pay for them now. So when it comes to trading, timing is everything. Is there any other way that we can offset the cost, the pretty high cost of insurance for stocks? Can anybody think of any other ways? I can think of two different ways. One, I could use a collar. So because the price of the put makes that insurance so expensive because I'm buying an option, what if in addition to buying that put option, I sell a call option, a higher strike call option? Well, whatever it is I collect for that call can get matched up against what I paid for the put, making that whole value of insurance much, 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 much cheaper. Sometimes it can be zero. Sometimes I can actually even get a credit. But, the problem is now I have this short call. Now, about a month or so ago, I think it was, I did a webinar here for Firstrade on covered calls, and that's what I'm talking about, adding a covered call to this. I think I did one on collars too, if I'm not mistaken. If not, I got one coming up. The problem though with that is if the stock goes up above the strike price of the call, I have to do some trade management. And so that's not a deal breaker, but I've got to be pretty well versed in how to manage collars. The other thing I can do also involves selling an option to offset the cost of buying that put option. And that's selling a different put. I could, if it's a $50 stock, I could buy that $50 put, but maybe then I could sell a 40 strike put. 40 strike put's going to be cost less because it's further from the money. So it won't totally offset the cost of the $50 put, but it'll partially offset it. That's pretty beneficial. It makes the insurance cheaper. Might take it from 3% to 2% or to 1.5% or even to 1%. But what's the problem with that? The whole reason we're buying puts, like if you're afraid that the stock might go down 1%, 2%, you don't buy puts, you just ride the darn thing out. You really only buy puts if you expect it to fall massively. And buying a put spread, like buying those 50 puts, but trying to offset the cost by selling the 40 puts, well, you're only covered up to the stock going down to 40. You're covered from 50, 49, 48, 47, 46, 45, 43, 41. But once it goes down to 40, all your protection is gone. So, there's not really a perfect solution, but there are solutions. And I think if there's one takeaway here, is that the more you learn, the more you earn when it comes to option trading. That's why I always give away some way to continue to get more free education in that, and also on our social media. You can find me on, let's see, YouTube, Instagram, and Facebook. It's all /Market Taker Mentoring, 2 T's in a row, all one word. On X, I'm Dan _Passarelli. I put out a daily video on YouTube these days. So in summary, the married put and protected put are ways to protect the value of an underlying asset, a stock or ETF. Married put is buying the stock and the put in one transaction. Protected put is buying a put on a stock that I already own. All right, do we have any questions before we wrap up and call it a day? Do we have any questions on any of this before we wrap up and call it a day? Nope. Good. I must have done a good job explaining it. All right. I'll pat myself on the back over here. All right, folks, have a great rest of your day. I'm going to see you 1 week from today. And, well, we got another really, really good topic. I think it's how to trade this election. That's going to be a good one. That's on election day, too. All right. Have a great rest of your day, folks. This is Dan Passarelli. I want you to trade smart.